$300 billion. That isn't the GDP of a sovereign nation. That is the implied market capitalization swing that Wall Street is facing the moment the opening bell rings. Right now, the fate of global liquidity doesn't hinge on the Federal Reserve's interest rate decision, nor on policy coming out of the White House. It is entirely tethered to a single ticker symbol. Think of it as placing the entire market value of 3 Intel corporations on the table for a binary, all or nothing bet. This is the macro reality we must face this week. Nvidia's earnings day. Let's reframe your perspective. This isn't just a quarterly earnings report for a tech company. This is a comprehensive stress test for the artificial intelligence asset bubble. Current market valuations are like a liquidity rubber band stretched to its absolute limit, and the earnings sheet in Nvidia's hand is the catalyst that could trigger a violent mean reversion. Today, we are going to dissect this $600 billion source of volatility under a valuation microscope. This isn't just a math problem. It's a market structure problem. We need to tune out the noise and examine risk exposure the way an institutional trader does. In this casino dominated by high-frequency trading, there is only one rule that matters: how to execute an effective exit strategy. First, let's take a step back and assess market sentiment. Current bullish sentiment has transcended rationality and entered a phase of near-religious fervor. When you see retail traders on Main Street and the Wall Street Bets forum on Reddit all crowding into the exact same trade, that is the classic signal of an overly crowded position. Why is this dangerous? Because we are dealing with Wall Street's cruelest pricing law: priced for perfection. Let me explain this in quantitative terms. Over the past year, Nvidia hasn't just beaten expectations, it has reshaped the benchmark. Now, the buy-side analysts are incredibly demanding. Simply beating earnings per share EPS estimates is no longer enough. The market has already priced in the most optimistic scenario for the next 3 years: an infinite total addressable market TAM, flawless execution, and zero competition. In finance, we look at the second derivative of growth acceleration. The market is no longer looking at the absolute profit figures. They are watching to see if the acceleration of that profit growth is slowing down. It's like driving a Ferrari on the highway. Cruising at 200 miles per hour is the baseline expectation. But if the acceleration drops even slightly, even if you are still speeding up, algorithmic trading bots will instantly execute sell orders. If Nvidia hints that growth is 1% slower than last quarter at these trading multiples, that is a catalyst for a disastrous valuation re-rating. The margin for error is zero. Let's dive into the fundamentals. Let's talk about capital expenditure. Capital expenditure. The current AI boom is, at its core, an arms race between Silicon Valley's Big Four, Microsoft, Google, Meta, and Amazon. These companies are trapped in a classic game theory scenario: the prisoner's dilemma. If you are Google CEO Sundar Pichai, do you know that the current return on investment ROI for AI applications is negative? Of course you do. Current revenue streams cannot cover the massive infrastructure costs. Do you want to cut capital expenditure? Absolutely. Your CFO is warning you about cash flow pressure every day. But you don't dare stop. Because if Satya Nadella at Microsoft keeps stacking computing power, Bing could algorithmically overtake you and dismantle your search advertising moat. This is defensive spending purely for survival. So, despite margin compression, they are forced to transfer hundreds of billions of dollars annually onto Nvidia's balance sheet to buy expensive H100 and Blackwell GPUs. Nvidia, as the exclusive supplier of the shovels in this gold rush, enjoys a monopoly premium. However, there is a macro math loophole here. Sequoia Capital has already sounded the alarm. Let's look at the core data. To justify the hardware capital expenditure these giants are spending, the AI industry needs to generate about $600 billion in incremental revenue annually. Note that number, $600 billion. But reality is disconnected. If you add up all global AI software subscriptions and API revenue, it barely scrapes a few tens of billions. There is a revenue gap of over $500 billion. It's as if you invested $1 million to build a restaurant, but your daily cash flow is only enough to sell a few hot dogs. This is what we call a valuation bubble. Current buying is based on discounting the future, driven by a capital expenditure cycle fueled by fear. The tech giants fear falling behind technologically. Retail investors fear missing out. FOMO. But the risk is this: fear is not sustainable. Once Wall Street demands to see free cash flow conversion, if just one giant, say, Meta decides to cut its capital expenditure guidance for next year, Nvidia's order book faces massive default risk. This is the systemic risk of excessive customer concentration. Beyond the flaws in business logic, Nvidia faces two specific tail risks. The first is a physics bottleneck. All eyes are on Nvidia's latest Blackwell architecture. This is their core moat. However, supply chain intelligence suggests issues with thermal design power. The heat generated by these chips at rack density could cause servers to overheat. This isn't a simple assembly issue. If cooling solutions aren't adequate, it means redesigns and delivery delays. In the tech world, time to market is everything. A 3-month delay gives AMD a valuable window of opportunity. This would directly hit Nvidia's high gross margins. Once margins mean revert, the valuation model collapses. The second headwind is geopolitical risk. We are on the eve of the Trump 2 era. As investors, you must price in macro policy risks, tariffs, and trade protectionism. Nvidia's supply chain is highly globalized, designed in California, manufactured by TSMC in Taiwan. If trade barriers escalate, or if new export controls are implemented for national security reasons, targeting the Middle East, for example, this cuts off critical revenue streams. This is an asymmetric policy risk you cannot see on a candlestick chart. Hearing this, your risk aversion has likely spiked. You might be thinking about liquidating everything and sitting in cash. No, that is not how professional investors operate. In financial markets, volatility equals opportunity. You don't need panic, you need risk management. Here is your institutional grade playbook. Rule has shown, avoid the gamma squeeze. Do not gamble on options right before earnings. Absolutely not. Those get-rich-quick stories on Reddit are examples of survivor bias. During earnings season, Nvidia's implied volatility, IV, is sky high. This means the market has already priced in a massive move. To make a profit, the stock price must move more drastically than expected. If the earnings are good and the stock rises 5%, but fails to meet the implied volatility expectation, you will still lose money due to IV crush. Do not go picking up pennies in front of a steamroller. Rule #2. The core satellite strategy. This is a standard hedge fund configuration. Allocate 80% of your capital to core assets, the S&P 500 or NASDAQ 100. This is your beta return. If Nvidia rallies, the index benefits. If Nvidia crashes, the diversification of the index protects your principal. Use the remaining 20% risk capital as a satellite to chase alpha. You can allocate this to Nvidia stock or a semiconductor ETF. This is an asymmetric bet. You limit your downside risk while retaining upside explosive potential. Rule #3. Hedge via utilities. If you believe tech valuations are too high, look for second-order beneficiaries. Regardless of who wins the AI model war, one thing is certain. Artificial intelligence is a massive energy consumer. Future data centers are essentially power plants with computing capabilities. Go long on power infrastructure. Focus on the utilities and nuclear energy sectors, such as Vistra Energy or Constellation Energy. These companies offer high certainty. In a gold rush, the steadiest strategy is selling water, and in the AI era, electricity is water. Rule #4. Execute strict trailing stops. If you hold Nvidia and have floating profits, congratulations. But do not let greed take over the trade. Set a trailing stop loss. No one can predict the top. Not even CEO Jensen Huang. Set a trigger line at a 10% or 15% drawdown. If the price pulls back 15% from its high, let the algorithm execute the sell order automatically. This way, you capture the beta of the uptrend while locking in profits. Don't fall in love with the stock. Use technical tools to eliminate emotional interference and prevent a massive paper gain from turning into a loss. Finally, let's talk about market psychology. Staring at the quotes on the screen, we are prone to fear of missing out. But please, remember the lessons of historical cycles. Cisco Systems in the year 2000 was the Nvidia of its day. It was the king of internet infrastructure, the most valuable company in the world. The result, after the bubble burst, it dropped 80%. Even though it remained a great company, it took the stock price fully 20 years to return to its highs. If you buy at the peak of a valuation bubble, your opportunity cost of time is enormous. A great company does not equal a great stock, especially when the price has already overdrawn the cash flow of the next decade. In a market full of noise and algorithmic warfare, your most valuable assets are discipline and patience. Block out the emotions. Trust the data. In this feast of liquidity, only those who keep one eye on the exit will hold on to their winnings when the music stops. That is this week's trading strategy. Remember, capital preservation is the prerequisite for a comeback. Good luck.